and you're obviously alone until it diverges, right? You gotta leave the trade alone until it diverges. Otherwise, it's a bad bit of business because you're trading. You might get lucky, but then it would be lucky instead of a straightforward trade, right? So if you're looking at the Pro I1, does it look like the spread is stopped or not? Look at the blue line, guys. Does that look like the spread has stopped? Or is it still extending? No, so it's a spread trade, Ulrich, right? It's a spread trade. It's not an outright. If you look at the difference between that and the buy trade, does it look like the spread has stopped? Big difference, right? So when the spread has stopped spreading, you've now got a great opportunity to play into this as a buyer, haven't you? When the spread has stopped spreading, you've got a great opportunity to trade into this as a buyer. When the spread has stopped spreading, you've got a great opportunity to tune into this as a buyer, right? But when the spread is spreading, it's a spread trade. You can't sell the market. You can't sell short the market. It's a bad deal. You wait for the spread to stop spreading, and then you take your shot. So we could argue that it stopped spreading on this one because it's not made a higher high. So we could have argued that this would have at least given you your first chance to start selling the 39 handle, right? Because when you see the spread spreading, it's not an outright trade, it's a spread outcome. And what was the spread? Well, of course, the spread that I was talking about was the dollar, right? So the spread was this here. So in other words, you're selling this, but you're buying this. You might be selling this, but you're buying this. The trade is not on gold. The trade is on the other marketplace. So if it's blue, you have to be really careful about selling. Unless you've saw a solid divergence, you have to be really careful about selling this short. There's a really good example of making a bad trade under the circumstances, and this is a great example of it because the trade is on the spread, not on the marketplace. So whatever you're doing, you're going to trade this, and obviously the spread makes a lot of cash. The spread makes a lot of cash on that occasion, and you wait for the spread to stop spreading. And when the spread stops spreading, your opportunity is to step up into the market at that stage and say, that's my deal. Take a shot.